we thought about it for a while, and we said, what do people really want to hear about? And if you're an entrepreneur, you want to hear about money. Where do I get money? How do I get money? And what type of relationships do I need to enter into with people who can get it to us? So the event tonight is an overview of each individual topic as we go through the series, and we put together a very distinguished panel here of people from various sectors within the tech community that can help you with those various stages. I'd like to make one other comment before we start. I think the best way that these type of presentations work is that we have interaction with the audience and the panel. So rather than have each one of them go through their spiel and have me ask a bunch of questions, as you think of something or you need some clarification, please, I would encourage each of you to raise your hand and let's get this to be an interactive discussion. And I would also encourage the panelists, to do the same. If you hear something that you'd like to talk about from another person's area, please let's get this interactive. So let's get this thing started. Normally, what we would do is start at the beginning with the earlier stage funding. But tonight, one of our distinguished panelists, Hippeau, from EisnerAmper, who is the head of our SEC practice, was good enough to appear tonight. And Pete, unfortunately, has a commitment that he has to be out of here probably within the next half hour. So we decided let's start at the end. Let's start at the IPO. So Pete has a tremendous amount of experience in the IPO arena. So Pete, why don't you just give the audience a little bit of your background, where you come from, what you've done, and then let's get into the discussion.
Is this mic'd or do I need a? Thank you, Pete Bible with EisnerAmper, as Mike said. I started my career in public accounting. I was a made partner with Deloitte & Touche here in Manhattan. After that, I made a brief stop at my first technology company, GTE, which eventually merged into Verizon. And then I went over to Detroit and spent 10 years at General Motors as the Chief Accounting Officer. And as that wave formed out in the Atlantic and the Pacific, I decided it was probably the best time to get out of Detroit. And I joined EisnerAmper, and since then I've been in charge of the SEC practice, and now I'm the firm's Chief Risk Officer. And I have done, I used to know this, I think I'm up to 35 IPOs.
So this is a man that can give you some really good insight to the process. So first question, Pete, is why do this? Why go down that path? What should the company be thinking about before they actually start down the path of going IPO?
Yeah, that's a good question, Mike. Over the last 2 years, there's been a very large demand for tech companies in the IPO space, companies going public and getting their shares in the market. That's really driven, you have to have the supply and the demand. Obviously, the demand's there from the investing side, but a lot of companies really don't have a choice. They've taken, whether it be angel money, VC money, private equity money, and those people want a liquidity event. So the shares they're holding, they want them registered so they can sell them, and also to raise money to take out their position in the company. So a lot of times I was listening to a political debate in the back, and so I don't want to have that influence me, but the banking system today for companies like tech companies is always shut down. To get credit, if you will, from a commercial bank, you have to be AAA. So what's really ironic is the Dodd-Frank Act has actually restricted lending to people who need it most. So anyway, because of that, really the only place you can get money for a refund is the public equity markets. So that's why a lot of people have been going there. The old days where private equity could leverage its exit through another private equity are gone. And now, so they're looking to the IPOs or the equity markets for that exit vehicle.
Okay. So, excuse me. Is there, I mean, I heard you say that, they almost have no choice, right? But you also hear a lot of people say, well, why would you want to go through the headache of going public, okay? There's an awful lot involved, right? So what, when companies face that decision, right? Or maybe they don't have a choice based on what you're saying, Steve. Why should they, why not just stay private? Why subject themselves to the rigors of the public marketplace?
Right, well, I think the first key is you have someone with a passion about something. They have a technology, they've wed to, they're convinced it will work, it's part of their life, it's one of their children, and that's really the first thing. And then to bring that to fruition, you need capital, you need money. And so, if that passion's there and the money's not, you tend to go where you can get the money to get the dream, to fruition. And like I said, the only thing that is really available now and as painful as it is the equity markets. It is costly, it is painful. I could take you through it if you'd like to hear the rigors of it. And nothing will ever really work as planned, but it's what a lot of people have chosen to do.
So to add on to that, so describe the process. I mean, what, from start to finish, what is it, just so everybody, I don't know how many people in the audience may have any experience with taking companies public. If they do, I mean, anybody here at all ever been involved? One, two, a few, right? So some of the people in this audience may have a pretty good idea. So why don't you just give somebody a flavor for everybody here a flavor of what's actually involved from start to finish?
Sure. Was there a question back there?
Yeah, I don't know if you're taking questions now, but...
Yeah, sure. I encourage that. I'd like to get the discussion flowing. Right?
I get that it's much harder for startup businesses to raise... Oh, sorry.
Can everybody hear?
What do you do on my person?
So I'll speak louder. My name is Solange Shira, and I'm on the board of Integral Board Group. And I understand that it's much harder now for banks to loan money to startup organizations. And you're saying that the best vehicle to raise money is, thank you, the best vehicle to raise money is an IPO. But there's a beautiful piece of legislation that was passed called the Jobs Act. And most people don't know about it. And I'm curious, from your point of view, why we're not using more of the crowdsourcing that the Jobs Act was meant to encourage.
Right. Well, that's a great question, by the way. On the bottom of my list here was to talk about the Jobs Act. So that,
sorry, I preempted.
No, that's great.
Let me go there since you brought it up, because it is great. I mean, what I've seen with the Jobs Act is people have been using the confidential filing quite a bit, and it's been wildly successful because it allows you to put your document in without the media getting hold of it. I think people remember that old thing called Groupon.
Yeah.
A little while back, where their accounting was exposed to the light of day before they really had a chance to deal with it. So that prevents that from happening and destroying company value. But unfortunately, the crowdfunding, the equity piece is the rules aren't written yet. So from Washington. So if somebody tells you they have an equity platform, run as fast as you can in the opposite direction because it's not legitimate. So the Jobs Act is a beautiful thing. I think it'll do great things. But as far as the ability to raise equity through crowdfunding, the rules aren't written yet.
So Dodd-Frank was passed in 2010. We
Yes.
still don't have guidelines or regulations from the SEC.
Right.
Is the Jobs Act going to fall into the same time schedule, so we're never going to see anything?
I gave up trying to predict what comes out of Washington a long time ago, but I wouldn't be surprised if it's at least that or not longer. So, but anyway, any other questions before we go on? Mike wanted me to talk about kind of the process. So it usually starts with, you need capital. So what the first thing you do is you get yourself an accounting firm and a law firm. And you have to pull together a set of financial statements for the size companies we're dealing with in the room. That's 2 years of financial statements and notes. There is something called management's discussion, which is a write-up about management's view of the operations and the liquidity and the prospects of the company. And then there's all kinds of other data. And one thing you'll find out being a public company, it's all out there, man. It's all, transparency is the word. So if you don't mind your neighbors and your family knowing your comp, it's going to be out there if you're one of the top 5 officers. So anyway, there's a very complex, thick document called an S1 that has to come together. And that's really a love interest of the lawyers, the accountants, and management. And when we're talking with some of these companies, management may be 1, maybe 2 people who are very, very much focused on the technology or where the company's going, and they're not, really willing or able to spend the time necessary with this document or with the professionals. So that's a drain on the creative side of the business. You'll be romanced to death by if you're doing an underwriting, which means you're raising capital, you'll be romanced to death by all the underwriters, telling you how great you are, how much money they're going to raise, that you're going to love them, they're going to make you a rich person, so on and so forth. Well, okay, that's the dating, then comes the marriage, and then what happens from there. So anyway, what'll happen is once this document's pulled together, you'll file it with the Securities and Exchange Commission. Most companies do it confidentially now, and you will get a series of reviews. Now, tech companies are used to moving at a disruptive speed. This is not that. This is a very laborious, long, prolonged, painful process. And it may be 2, 3, 4 rounds of comments from the staff, most of which, when you talk to securities lawyers, deal with the financial statements. And if the company's raised a lot of capital beforehand, a lot of the instruments are very complex. They contain what's called derivative features, which have to be marked to market, and there is really no market, so it becomes overly complex. So you've gone now, you've pulled the document together, you've filed it with the commission, you've cleared the comments. Now these bankers that promised you all this money are going to take you on what's called a roadshow, where you go out and meet with potential investors, all right? And all of a sudden, guess what? You're not so pretty. And they're not the 30 million they promised you turns into 13. So that's part of the process. I tell people it's like, anybody here commuting this morning from the west? 80, 78. I mean, you leave your house thinking, bright sunshiny day, everything's gonna go well. 4 hours later, you hit the city. That's the IPO process. So it's not for the faint of heart. You need to be patient. You will get there, but it is very, very, it draws the creative juice out of the company. I think is probably the best way to say it. So if you're thinking about doing this, get the professionals necessary to help you so you can stay focused on the business. Eventually, there will be a closing. The underwriters buy your securities, they'll write you a check, and they go out and sell them in the marketplace. That's kind of the process from scoop to nuts, but it'll never go, Murphy's Law reigns every day. It'll never go where you think it's going to go. Things will change, the staff will take it, the staff of the SEC will take a different view. The investors on the banker side will pull out, they'll replace them with new investors. It's a very, very difficult process. And so my best advice to anybody going public is if you're on the creative side of your business, if you're driving the technology, if you're driving the product, hire somebody to handle this for you. You don't need the headache.
And just to add on to that, Pete, just give the audience some idea of what it costs to actually go.
Oh boy,
to go through it. A range. I mean, you never. No two situations are the same, right? But,
right. But one party's always at the top of the payroll. The investment banker will take a cut. It's a pretty heavy cut. He'll get about anywhere from 10 to 15% of your proceeds. The attorneys are right behind him, and the printers and the accountants are taking up the rear. But the quickest I've seen this done is 6 months. I've seen some 2 months, 2 years into it. They're still not done. Unfortunately, with time comes more dollars and fees. Typically you're gonna, if you want to raise, let's say 25 million, you're gonna probably realize 18 of that.
pretty expensive.
Yeah, very expensive.
Yeah. All right. So now so now we've made it, right?
Yeah, you're public.
You're public, all right?
Welcome.
Now what? All right. What can the top management of the company expect in terms of regimented reporting, all those requirements, the things that you didn't need to worry about, right, when you were private, right? what's the extra added zing you're going to get now from being a public company?
Yeah, zing or sting?
Sting.
Well, first of all, you're going to have a board of directors, all right? And some of those people are going to have to be independent. You're going to have to put a corporate governance structure in place, which for a lot of smaller tech companies is just not in their DNA. It's just not. You're going to need to have a very sophisticated legal and finance staff and structure, and have the internal controls necessary to be able to produce reliable financials quarterly. So all that summed up is it's a fairly expensive, pretty big price tag. If you're dealing with a chief legal officer or general counsel, you're dealing with a CFO, controller, one or two bookkeepers or accountants. Board members want money. You want independent board members who are going to want to have a say in perhaps how you're directing the company or driving the company, which for most people is more of an issue than the dollars. And you have to have an audit committee that is responsible for the financials and is going to want to know what's going on in the operations. And and near and dear to a lot of people's hearts, you're going to have a compensation committee, and they're going to determine what you make. So a lot goes into this. Fortunately, where public companies have ended up over the last several years is you have regulators that react to crisis by throwing the best, worst idea into law. You have the media who steers things. So, it's really a shame. It's very difficult to have creative genius anymore in some of these companies because they're occupied in, quite frankly, compliance.
Thanks, Pete. And
You're welcome.
last question. So you hear anything that any other panel want to say about this, or should we just keep going? Because we're almost done with the end. Okay.
All right.
Okay. Last question. So you hear about companies who are public, all of a sudden, you know what? Maybe we don't want to be in this place anymore. So, and now we want to go. Now we want to get out of the public marketplace. We want to go private. So, what are the reasons that happens? And describe that process a little bit.
Yeah, the young lady that brought up the Jobs Act. That's probably one of the big benefits is the ability to go private by raising the limits for what's considered to be a public company. The number of shareholders, the amount of capital you can have out there in the market and still be considered private. That's huge, and really, we haven't seen people really take advantage of it. But the reason most people want out of being a public company is the drain on corporate resources, whether it be intellectual or monetary. I think the compliance aspect, and it's basically you have to buy back the shares you issued. That's how you are no longer public, and so that requires capital. And people do it in dribs and drabs. Anybody ever heard of the stock buyback programs?
Sure.
Yeah, that's what's going on there. And to a lesser extent, but you're reducing the float. You try to manage the float, not only to manage the stock price, but manage the potential to do this very thing. So it's, the good news is you can whittle away to get down to a certain number of investors and basically declare yourself private through a filing. In the old days, basically you had to go out and tender for the shares. That's been very much enhanced by the Jobs Act.
Okay. Anybody have any other questions of Pete before he has to scram out of here?
Yeah, sorry, one of my other lives is I run the Minden Athletic Boosters, so I have a dinner tonight.
Okay. Thanks, Pete. So let's move on, or let's go back to the beginning. And so tech company has gotten themselves off the ground. They've, thanks Pete, they've funded it, bootstrapped it, funded it themselves, maybe put some friends and family money into the company, and now they're ready to go out to the marketplace. And I'm sure you all know the term angel investing. Tonight on the panel we probably have the preeminent angel investor anywhere. David's reputation precedes himself. So I'm going to turn this, I don't think I have to even ask David. I had some questions for David. I don't think I have to even ask him questions. He has his own presentation. I'll let him go, and I'm sure you'll find this very enjoyable. Thanks, Dave.
Okay, so first, I am going to take the speaker's prerogative and start you off with an ad for New York City. Why are we here? Why is this the New York Tech Council, right? Because there's something that most of you guys probably don't know, and I think it's going to be an eye-opener for what New York City has been doing in terms of its tech growth. This is short, and then we'll get into the angel investing.
New York City is the fastest growing tech startup community in the world.
New York City is the world capital of hyper-tech. That's tech applied to everything else that New York City is already the world capital of.
Whether it's finance or real estate or fashion.
It's such a multi-dimensional city.
I think it's insulting to call it Silicon Valley. This is New York City. This is going to be New Tech City.
New York is a place where people come and they get stuff done.
People here are building real businesses that affect real people.
New York City has always been the most exciting place in the world to start a business. That's not new news.
Digital.nyc is an amazing public-private partnership. The city of New York is making this its official hub for everything startup.
We're bigger than some of our community when you know that the government and mayor have your back.
As a startup founder, people that I meet are constantly asking me, where can I find a list of all the best startups in the city?
Digital.nyc is the only place that has a one-stop shop for New York tech.
It's going to be real-time, active. We're actually bringing together the tech ecosystem into one place.
Digital.nyc really enables that growth by creating a community.
You never really know what's right around you.
Everything is connected to technology, whether you're a student, an employer, an employee, a government person, an advertising person.
This awesome portal as a way to kind of bring folks together so that we are in fact a community.
Digital.nyc is something that we need.
Wow, I wish that existed when we were first starting.
They've done a lot of legwork for you.
Truly, as a New Yorker, I couldn't be prouder of my city and more excited about the future.
News, startups,
Events,
Jobs,
investors,
Resources,
maps, courses,
workspaces,
incubators,
accelerators,
videos.
blogs,
It's all here in one place. That's Digital.nyc.
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 digital.nyc. Digital.nyc.
New York City's hub for tech and startups.
So, this is a website. That is the domain, digital.nyc. It's not a brand, that's the actual domain. New York City is one of the first cities in the world to have its own domain, which is .nyc. And one of the very first sites launched there is digital.nyc, which is a single directory for every single thing happening in the entire tech area of New York. It's got all the startups and the investors and all the stuff you heard, jobs and events, single coordinated event calendar. Go check it out and you'll see all this stuff happening around. Okay, with that advertisement done, let me now talk to you about angel investment. And I'll do a really quick overview and then we can take questions. So the first question is, why do people become angel investors? Why, speaking out from the investing side of the house, not the getting money side of the house, what is it about angel investing that makes it make sense for us? Because if you think about it, there are a lot of other ways to put your money to work. So, for example, you can put your money in a bank account. The only problem is if you tried that recently, you're getting maybe 1% if you're lucky. But if you put it on the other hand in the stock market, averaging over time about 5%. Put it in a hedge fund, 10, private equity, 15. VCs, we'll hear from our VC in the panel. Most VCs these days, if they're lucky, are targeting a 20% return for their LPs. So if you can get, by investing in Lerer Hippeau Ventures, a 20% return, why on earth would you ever want to get to this crazy, insane world as an investor of investing in you crazy people over here who are entrepreneurs and startups? And the answer is, for people like me, angel investors, if you do it right and really carefully over time, you can actually get 25% IRR, and that's what the average return is for a professionally managed angel investment portfolio over time. So, the question is, how do you do this? Well, it's very simple. You go out and you look under every rock, you look into every garage, and you find some scruffy guys who look like this. And then you go and you write them a check. That's a guy named Mark Markula, right? The first check of these scruffy guys. And then you sort of mix it up and you put it in the oven to bake for a while, and you spend about 5 or 6 years at it. And the scruffy guys grow up and turn into this kind of thing over there. And the thing in the garage turns into the world's most valuable company. So you see, very simple. That's exactly the way it works. But it wasn't just Apple. It was angel money. Effectively, every single company on the New York Stock Exchange and the NASDAQ took in outside capital from somewhere, somehow, at some point before they went public. And these are all companies that were angel-backed. And so angel funding before going public, before private equity, before VCs, is one of the backbones of the whole world of American enterprise. So let me start out by putting things into context, right? So let's take and this will sort of set the scene for everything else that's happening today. This is a chart showing where in the process different forms of capital come in. And so going from left to right over here, this is the sequence and the life cycle of a company. And it's sort of linear. You start with an idea, and then you work on a business plan, and then you prototype your site or your invention, whatever you have. Then you actually get into beta. You've got beta testers over here and some pilots. And then you've got sales. People are paying you money for it. And then you're finally making money from your business. And so over here, you see the amounts of money that you can take in at various points in the spectrum. Now the interesting thing is, while this is a sort of linear scale, over time you start here and you get over there, this is what's known as a logarithmic scale. So this is 0, so this first thing here is 100,000, but the next one is 1,000,000. So this is 10, from here to here is 10 times the amount. The next one is 10 million, and then 100 million. So this is really, really compressed. So if you were to actually do this on a linear scale, the top of this chart would be sort of the top of the building over here. So the numbers get really much bigger as they go up. Okay, so where does the very first money in a startup company come from? Audience interaction.
Mom and Dad.
Good for you. Yes, your own credit cards, or your own cash, or your own retirement fund, or your own mortgage in your house, or stealing it from your kids' candy money, or whatever it is. But basically, it comes from you, the entrepreneur. Because if you don't put money into your own venture, nobody else can put in a penny. So, okay, after your cash comes in, then where do we go? Well, then we go to friends and family, and some others. And so the trick here is that the people who are putting in this kind of cash are investing not because they're experts in the domain, not because they can analyze pro formas and spreadsheets and stuff. They are investing in you. And that first round of cash you're going to take in from friends and family is basically people who are betting on you because they love you, because they trust you, because they think you're a tech genius, for whatever reason. They're going to be backing you. And the amount that they're going to typically put in, they'll come in at the earliest stage when you have an idea, as long as you can sweet talk them or bribe them or coerce them to put in cash in. Typically, most people are able to get some tens of thousands of dollars from their friends and family. If you can't get anything, even a few $1,000s from friends and family, you might want to sort of either rethink your friends and family or rethink your ability to raise money. But beyond that, most people are not going to pull in much more than 100,000, a couple $100,000, unless your name is Rockefeller or the Brin family or something. So having done that, okay, now you need more money. Where's the next thing? Well, now, hopefully, you're a little farther down the line here. Not just an idea, you actually have a prototype. You have a plan that's actually had some kind of traction. Well, that's where angels come in. So angel investors are individual people who are investing their own cash. They're not venture funds. They're not public markets. They're individuals who are investing their own cash into your company. And they have, because they're individuals, a whole host of reasons why they invest and a host of different amounts as to what they can invest in. Typically, though, you'll see angels start off somewhere in the $5,000 or $10,000 kind of range and go up to the multiple hundreds of thousands of dollars. The average angel investment per angel, per company in the U.S. is about $25,000 at a given time. So that means if you're going to try and get a bunch of them together, you can maybe get $250,000 from 10 people putting $25K a piece. You may luck out into one really, really rich woman who puts you, in bonbons for all the way up to your IPO, but that's a little unusual. Then the next piece along the way, or the next largest amount of cash, is actually a surprising one. This is free money. And so there actually is a source for free money. It's called the federal government. They have a program called the SBIR program, Small Business Innovation Research, or STTR, Small Business Technology Transfer Grants, where every government agency that has a budget of a given size is required by law to make a little piece of that available to grants, just free money, giving it to you, to small startup companies. The idea being to encourage innovation, to take some of the risk off the table for private sector investors. And so each agency, there are 17 agencies that do SBIR grants, and they will put out a list of the kinds of things they're looking for. And if you're in an area that's doing something that might be appropriate for a grant, by all means, go ahead, submit. The process takes a while. It'll take many months to get through it. But the hit rate is surprisingly high. Something like 25% of companies that apply for SBIR funding actually get it. Okay, that's the beginning and end of free money. So now where do we go? Well, now you have people like me getting together with other people like me. You've got angel groups. And so angel groups are sort of self-aggregated organizations of individual angel investors who will pool their capital. They will put in dues, they will hire a staff, they will set up a website, they will function not quite as efficiently and effectively as a venture fund, but more so typically than an individual angel. And so New York Angels, for example, which I founded here in New York, is one of the most active angel groups in the world, has invested many tens of millions of dollars over the years in many companies. Our members were the first investors in companies like Pinterest. We were the investors, the primary and only investors in Comixology, which was acquired by Amazon, and folks like that. And so typically, angels who are looking at this professionally in groups are looking for something other than ideal. Once you get past the sort of SBIR, end of the world, you can't get away with an idea. You got to have something, some traction, something more than a concept. And so angel groups are looking for people who have got their business going. Not an idea, not a plan. You really have to have a business. So angel groups invest in businesses, and typically the average angel group in the U.S., and there are hundreds of them, literally 300 or 400 angel groups in the U.S. I run a platform called Gus that back ends well over 800 or 900 angel groups around the world. Typically, they will invest anywhere from $250,000 to $750,000. That would be the sort of sweet spot in there, $500,000 or more. Together, you get a couple of groups together, you can get over $1 million from these angel groups. But they're individuals who are investing typically one at a time. Well, they might also get together and invest as a group with one check. Okay, now, and only now, do you hit VC for traditional venture funds. So my colleague over here is going to talk about an early stage seed fund, which will often come down and play with us angels in the earlier stage world. But traditional venture capital funds, the kinds you hear about, Kleiner Perkins, Sequoia, the big boys as we call them, are typically investing later. They'll start with what's called a Series A round, and they will typically put in a minimum of several million up to tens of millions of dollars based on how the company is doing. But for that, again, unless your name is Mark Zuckerberg, for your second company, they're not going to be investing in an idea. It's going to be investing in a real company which really has traction. It has a product that's done. It typically has users, may even have profit revenues at that point. Now, while all this is happening, there happens to be another group of people who spend a whole lot of points in the spectrum as well as dollars, and those are strategic investors. Strategic investors are typically companies, they're corporations, which have a venture arm, which are investing in smaller startup companies. Why? Because the big thing these days is innovation. I've often said that any company designed for success in the 20th century is doomed to failure in the 21st, because innovation is happening so fast now that if you don't innovate, you die. And typically, innovation is really hard for big companies, so they look for smaller companies who aren't innovating, either to help secure their food chain earlier on, their supply chain, or their customers, or enhance value to their products and stuff. And so they can invest anywhere in the whole spectrum, from a few $100,000 to tens of millions, and they can do it. They will do it in addition to giving you cash for ownership. They also have a strategic goal here as to what they're looking to get out of this relationship. And that means it's a two-edged sword. You have to look at their cash. Because they have a strategic addition on top, they're often willing to give you a higher valuation, effectively pay more for a piece of your company than a pure financial investor. So be careful about that, but if it works out, it can be a very interesting source of capital. So now, having gotten all that done, and you're now farther out to the right-hand side of this chart, you've actually got some sales in there. Once you've got sales, and once you're actually making money, now for the first time, you can go to banks, because as you heard from Peter, banks don't like to lend to tech startups. Why? Because banks are not in the investing business. Banks are not in the risk business. Banks don't want to hear that you might fail. Banks are in the renting money business. So they will give you money because they want to get that money back at the end of the year, along with rent on that money, which is interest.
By the way, David, not to interrupt, but we have two members of our, we have two members of our panel who may tend to disagree with you slightly, right?
Are banks in the investing business?
We're in the lending business to companies that are not profitable.
Okay.
But they do have enterprise value that you're comfortable with the risk.
Right. So the bottom line is, because they're in the lending business, the goal here is they have to be sure they're getting their cash back. Investors are prepared to have a whole lot of their companies tank. Are you prepared to have any of your companies disappear? No.
No, I wouldn't be on the panel if I were.
Doesn't work that way, right? On the other hand, for investors, it happens, Andrea, right? And, so we take that as a risk, because we are investing as opposed to lending. So typically, while there are enlightened banks that will come a little earlier into the spectrum over here, banks typically are not great sources of capital for pure startups because there's nothing there. If they will lend you, it'll be on your signature, which means you are personally guaranteeing to pay it back regardless of what happens to the company. And so effectively, that's not a company loan, that's a personal loan to you, which is the same as your personal capital. And then at the end of the thing, as you heard, once you've gotten operations going, you've created really obvious value that the public market is going to pay for. Then, ta-da, you get to go to the public markets, you heard from Peter, and you get to sell your shares out there and create an idea. So with that, I'm going to leave this up here, I think, while we all talk, so you can sort of focus on where the world is. And I'm happy to answer questions from you or anybody else.
Does anybody have any direct questions for David at this point before we move on?
Hi. I wanted to say something about the New York State programs they have for startup tech companies that you're talking about, and
right. So the
State Development Fund and all that stuff.
Right, so you've seen a whole lot of ads for Startup New York. That's a great program. New York State is really taking the lead in tax programs, but that's a tax program. What that says is if you start a new company and create new jobs in an area that the state would like you to create new jobs in, read upstate New York, usually around city campuses, and you qualify, which isn't too hard, the state is prepared for 10 years to say no taxes. No corporate taxes, no real estate taxes, no franchise taxes, no sales taxes, no income taxes on your employees, which is no state income tax on your employees, which is really very cool. So, but the only problem is the reason tax things like that are not quite as helpful as they could be for startups is because that's taxes on money you're making. So first, you got to make money, then the state will give you a tax break. So it's not cash out. Although that being said, the state does put money into funds. There are a number of funds, sort of venture type funds from the state, and the state invests money in as an LP and other kinds of funds. But that would be falling into the typical venture fund category.
By the way, just for 1 second, just to talk about that New York State program, and we have tons of clients in the space, and I see very, very few. I think we have one client who may be involved in Startup New York, and maybe you did say it, David, and I just was concentrating on something else, but the thing that they don't tell you about is that you need to be housed and affiliated with a university, right? And that's something that's difficult to do, and you may not want to do for your business. So the tax breaks, the hell with the tax breaks, right? I need to be in a place where I can grow my business as opposed to being attached to a university. So you don't hear that about it. And I see lots of companies, and I see very, very few who are taking advantage of that.
It's a great program if you qualify and want to be upstate university.
Exactly. Right. So, yeah, sure. I'm sorry.
When you invest as part of an angel group, do you guys prefer investing in like convertible debt or as opposed to like Series C? What's the trend?
Sure. So the angels are equity investors. So you're buying a piece of the company. So nobody, not lending, right? We can talk to the lenders here about lending, but angels are equity, like VCs are equity investors. So then the only question is how do you actually pay for and structure the transaction? And the only difference realistically between a convertible note with a cap valuation and an equity round is a lot of legal expense, and so it ends up being the same. There is the idea that somehow angels will lend you a note and let you go up and get a lot of value and then come in later. Realistically, any legitimate angel group and any serious angel is going to say, right, it'll be a note, a loan effectively that converts into equity when the VC comes in, but we're going to cap the valuation at a specific number, and so the effect on you is almost effectively the same as if you raised it from an equity round at that number. So I wouldn't get too hung up on whether it's an equity round or whether it's a convertible note round. Michael?
More. Hi, Rocco Luisi, Integral Board Group. Do you, as an angel investor, prefer one particular type of entity to invest in, the corporation, LLC, or a state in which it's incorporated? Do you insist on a Delaware corp?
Most VCs and most angel groups will insist on investing into a Delaware C corporation. A C corp because you've got stock and it's easy. It's much easier to buy and to sell and to do appropriate series of preferred stock. It's a known entity. You can issue options to your employees. You can't really do options on an LLC. And so, again, if you come in and you're Mark Zuckerberg and you say, hey, here's my next company and I'm putting in $100 million and I'll let you come in for your thing, and we'll do whatever Mark Zuckerberg tells you, right? So at some point, it's a market. But given the fact that it is so competitive, angel investors invest in 1 out of every 40 deals that pitch them, right? So if there are 39 other companies over here, you're all at the same stage, and one of you is an Oklahoma LLC with its IP rights assigned to the mother-in-law of the whatever it is, and the other one is a Delaware C Corp, I can tell you which way you're going to invest.
Thank you.
All right, David, one more question before we give we've been hearing the debt players in the game being bashed. Let's give them
Not bashed at all, just saying different things in terms of with equity versus debt, risk versus not risk.
Okay. Somebody brought up the Jobs Act, and so crowdfunding. Has that had any real effect on the angel marketplace?
The Jobs Act of 2012, which was passed 2 years ago, has 3 titles, 3 major components. One of them has to do with what Peter was talking about, which is the ability to stay private longer, go public easier, do it confidentially, and that went into effect right away. And that's a good thing for companies when you're at or close to going public. Title II said it made one little change. It's because right now you can take money with your angel investors, people like me who invest. We have to be what are known as accredited investors, which means you have to have either have a certain income over $200,000 a year, or certain assets over $1 million, not including the value of your primary residence. So that's the way it's always has been. However, until the Jobs Act was passed, the rule said you can only get money from these accredited investors, but you can't tell anybody you're raising money, which made it a little difficult to raise money, as you can imagine. So one thing the Jobs Act Title II said was, okay, you still can only take money from accredited investors, but now you can tell people that you're raising money. And so that change opened, I would say, semi-floodgates for online equity funding portals, not crowdfunding portals for the crowd, but for accredited investors. So you've heard of things like Circle Up and Angel List and Funders Club and a bunch of other things. These are all portals for accredited investors. And so, because you can now advertise online. And so that's begun to have a very interesting effect. It's again, negligible in terms of the overall size. There are 700,000 companies that are started every year in the US. And so you're talking, a few hundred, maybe max, have gotten any kind of funding through portals since this started. But it's going to be a very interesting kind of play. Title III of the Jobs Act is the part, and so that went into effect a year ago last September. Title III is what allows for absolute crowdfunding. That says anybody without being an accredited investor can invest in a private company under a whole lot of rules. And so Congress, when it passed the law, set up a whole lot of rules and laws about doing this. And then they said to the SEC, okay, now you go ahead and write the specific rules. And the SEC, as you heard, really doesn't want to do this. The SEC does not think this is a good idea. Nobody at the SEC thinks it's a good idea. So they're saying, okay, fine, we'll write the rules, have your grandchildren come back and ask us what the rules are going to be, in several years. So it's the Jobs Act 2012, we're now heading to 2015. Unclear if it will be released this year, next year, the year after. There are a lot of people waiting and growing very long beards waiting for this to happen. But eventually something will happen. And at that point, we'll see what the effect is.
Great, thank you, David. All right, so nobody have any more questions for David at this point, or we'll move on. Let's move on to some of the let's move on to the debt side. We've been talking about equity, and I would pass the microphone down to Aaron. All right. So this is Aaron Elharar, right? From he's the head of sales of FastPay.
Yes.
So Aaron, why don't you let's give the debt people a little plug here, right?
Yeah.
And why don't you talk to the audience, because I don't know how many people out here know FastPay or what you do. So talk to FastPay. What type of lender is it? Who are the candidates, right? What's the criteria? Give us a little background.
Sure. So you might not know FastPay if you're not in the digital media industry. If you are in the digital media industry, you might know who we are. So FastPay is a lender that specializes specifically in digital media. We have a lot of traditional media clients, but specifically media, creative agencies, production companies, everything related to advertising. We've been in business for about 6 years. We've deployed about a little over $500 million in loans. We have several products, so we do primarily receivables financing. The one thing I will say, contrary to what David said, is that we require no personal guarantees, so line up later for signing up if you want. We have several products. So we do primarily receivables lending, because in digital media, for most companies, the primary asset they have are accounts receivable. They make sales right away. They sell to advertisers who pay them very slowly, so they can immediately get credit on their receivables. We do term loans up to $50 million for acquisitions and for long-term growth, long-term investments in the business. We also do vendor financing, like supply chain financing. So if you guys are familiar with the ad network model for in digital media, we do a lot of advanced payments to publishers. And finally, we do a lot of trade credit within digital media. So, and you asked for like just the qualifications, like how people qualify for our loans. So we have really, the reason we exist is kind of like a reason why Robin here exists. So Robin works at City National Bank and works in tech and venture banking. So we work with companies who, we're considered an alternative lender. So companies who work with us primarily because they either can't qualify for bank lending or because they just essentially don't want to deal with what it takes to get a bank loan, or they want more flexibility of a specialist lender. So the idea is we look for businesses that are high growth. We really only look at their receivables primarily. So companies don't have to be profitable. There are no personal guarantees. We have no covenants. The way the loans work is you can get up to 80% of your receivables as cash. And in terms of other products like our term debt, it's pretty straightforward. It's basically EBITDA covenants, things like that, profitability. And yeah, I mean, the primary thing is we're an alternative to banks.
And what about rates? I know you don't really love to talk about rates.
No, we love to talk about rates.
Okay, that's good. That's good.
I love to.
As opposed, I will tell you that the most expensive form of capital is equity, right? Because you're giving your pocketbook away. However, if you can finance your business, and most venture capitalists, angel investors will tell you, right? If you can find a way to finance and grow your business in other ways, why would you want to give away a piece of your company, right?
Mm-hmm.
I mean, and we'll get into it. There may be a lot of other reasons to have the venture capital venture capital firm or the angel investor come in the door, because they can do a tremendous amount of other things for your business, all right? But so when you talk about rates, all right, and it's going to be a little higher. It's not like you can go and borrow from FastPay at prime, right, which is 3.25%. Maybe you can, all right. So why don't you speak to that a little bit?
So you just made the sales pitch for us essentially. So we preach big time that we are an alternative to raising equity, specifically for a lot of our clients are companies that are on the way to raising equity, and we allow them. I mean, us ourselves, we avoided raising equity for a long time and used senior lender and sub debt, and we definitely preach that. So our clients are companies that we allow them to use their receivables to organically grow, and we obviously also have other products now where we're offering like term debt where they can grow without having to raise equity. But the idea is definitely what you just said. I mean, we think about it, if you're paying like rates, so our customers pay anywhere between say like 8% a year to 25% a year. And if you compare that to what you would give up in terms of equity, that's a big difference. I mean, I hope companies plan on returning more than 8% a year or 25% a year when they're selling the company. So big time, that's a huge selling point for us.
Right. And would you say FastPay is, how do people contact FastPay? Is it lending in an online environment, right? Or is it, I mean, how does that work? How would they know, other than if I refer a client to you, how do they find FastPay? How do they know about FastPay? I mean, you hear a lot about lending online, right? Is FastPay that type of lender, or is it more like a banking contact, like a Robin would have at City National?
Yeah, both. So we have, so I've led the sales group, so if you've heard about us, it's probably because of my team for the past several years. We've hounded you like animals. If you're in digital media, Robin knows about this. But so that was one way you've heard about us. But we also do a lot of, so we're as receivables lenders, we're advancing a lot of payments from debtors. So the way you might have heard about us online is since we focus on digital media, you're owed money by a lot of digital debtors, programmatic ad networks, things like that. And we focus a lot on partnerships directly with the debtors themselves. So a lot of our customers hear about us through the debtor, which is a very different way of finding out about a lender. As well as in terms of the execution of it as well, a lot of it is automated, so you can do it online. But we're not big on like discovering us, online. I mean, digital media itself is kind of a community. So all the programmatic players, the ad networks, the agencies, the debtors, the buyers, the suppliers. You really know them all. So as FastPay, we're about being embedded everywhere. If you're in some sort of digital media transaction, you're supposed to know who we are, or else I'll get fired probably.
And one last question. So you just mentioned FastPay just did an institutional round, right?
We did.
You're at $15 million?
$15 million, yeah. So we just did an equity round. So to give you a little bit of history about how FastPay, so we scaled the business up with sub-debt essentially. We had a senior line with Wells Fargo Capital Finance, and then we had SF Capital, which is a family office here in New York. We had sub-debt with them. They've been an amazing partner, so they funded us essentially with almost like an open checkbook to give us whatever we need. But we recently, the marketplace got a little more competitive recently. We've seen, people like Robin have been going a little more downstream. We've been going a little more upstream. The industry has definitely matured. So we've been in touch with VCs throughout since we've been in touch. There's been a lot of interest in the business. But Oak, HCFT, which is Oak, is a venture capital fund, recently started a healthcare and financial technology fund. We were their first investment, and they just really believed in what we did. So we've been investing a lot more in automation and a lot more in just growth and partnerships with debtors directly. So it required, we didn't raise money to deploy any of that money. We used debt to deploy out to our customers. So the equity was really to grow the business for hiring and for technology. We have like 15 engineers now. So we see ourselves more as a financial technology company. But yeah, we originally were preaching don't raise equity, but I think now the story is more, you can grow yourself with debt and then eventually raise equity later to really, fuel the fire.
Great. Anybody have any other questions there? Just somebody in the back?
Yeah, I'm just curious, what happens in the case of a default? Do you cease the business, or how do you get?
What happens in the case of a default is essentially what I'm curious about.
So that's a really good question. So a default for us, there's a lot of different terms in terms of, I can get really technical on this, but an event of default is, can be a lot of different things. So for us it depends on also which product you're talking about. Primarily it's receivables lending. So in the event of a default, we essentially have, stepping back a minute, we're a secured lender. So we take a priority position in the company's assets. So we have essentially all the receivables under our collateral, as well as the receivables are flowing through us. So event of a default is typically someone doesn't pay, so we'll usually collect back from the other receivables. If you're asking whether we are a recourse lender or non-recourse, we're definitely a recourse lender. I don't know if that was your question, if you were getting that technical. Was it?
Yeah.
I can't see you, so.
Yeah.
Okay, thank you.
Yeah. Do you require any warrant coverage or equity?
No, we don't require warrant coverage or equity. On our term loans, we will sometimes take warrant coverage, but it's really not our appetite. So on our receivables lines, definitely no. The only product we'd ever take warrant coverage on would be a term loan, and equity, never. Thank you for bringing that up. You guys can keep selling the product all day.
Okay, thank you. Let's move on. So let's go back to equity now. So David outlined it very well, right? You've got friends and family money, right? You've gone the angel route. Now it's time for your first institutional round. So very lucky and honored to have Andrea Hippeau from Lerer Hippeau Ventures here tonight. So, Andrea, why, Lerer Hippeau is an early stage and seed stage, probably similar to what the, probably in terms of size, one step above the angel.
Yeah, exactly.
Right, okay, so I guess that's, the question is where in the investor food chain does the early stage VC fit, right?
Yeah, and I think it's kind of evolved recently as well. So we invest between normally 500 to 800K in a $1 to $3 million round. So most companies have raised from folks like David or friends and family, anywhere between like 100 to 500K to build out the product. I think seed investing used to be kind of on the earlier side. So, with our first fund, we wrote 100 to 200K checks, but everything's kind of been moving up the food chain. So our check size has gone up as well as the round size.
So describe, what's the process? Early stage company, gets to the point where, they think that, they need that additional funding. What's the process? How long does it take? From the time that you're approached to the time that you actually fund the deal. Go through that.
I think our process is really unique because we're super active, so we do over 50 deals a year. There are some VCs that only do a couple deals a year, so really depends VC fund to VC fund. But the process is really that you come in, you meet with myself or another member of the investment team for an initial meeting. We have a partner meeting every week. We bring all the companies to the partners, and then if they want to move forward, you have to meet with 2 out of the 4 partners who give the green light. It's a really fast process. I get back to people within like 1 to 5 days, and the whole process can be anywhere from 2 to 4 weeks. But that's, I think, pretty unique to us because we're so active. I know that there are VCs it can take, a lot longer than that.
Right. Absolutely. Okay, and what do you look for in a company when company gives you their financials, their business plan? What are the key drivers in your positive decision-making process?
I think first of all, it's team. That they're smart entrepreneurs. They have some sort of industry expertise. Either they've started companies before, they've been working in the industry for a long time. They have some sort of advantage over other teams, and that they're passionate and really sharp. 2 is market size. That the product is in a big market, a growing market, and that it's a good product market fit as well. And then 3 is traction, and I think this is where sometimes entrepreneurs get a little bit lost when they come to us. We do look for a good amount of traction before making an investment. We're looking for really high engagement numbers. For a consumer app, we want it to have a lot of downloads, or for a SaaS business, we want to see a good amount of revenue. So I think there's a little bit of a misconception that seed stage are people, that we're investing in people with an idea on a napkin, and as David lined out, we're way past that point. So there is a little bit sometimes a chicken and an egg situation where people are coming with us because they need funding to build the product, but we can invest before, if there's at least some proof that the product has been proven at least somewhat, which is why angel investors are so great.
And the structure? I mean, are these, is it, you invest as common stockholders, preferred, convertible notes? And you heard David talk a little bit about that.
I think
before.
everything that David said was spot on. Convertible debt is, cap notes are primarily where we play, just because they're quick and easy, and they pretty much act the same way as equity. And then if it is a priced equity round, we do preferred.
And because you are, just like the angel investor, right? Because you are, earlier in the game, right? I mean, your ideal, I've heard rule of thumb, like for a VC investment, that, that if everything flows right from start to exit, everybody has it's a win-win for everybody, that a venture capital firm probably would wind up with somewhere between 20 and 30% of the company? Is that, you know, is that a true number? Is that
You mean
real?
from
or-
an ownership?
From an ownership percentage?
No.
Okay, and how does, you know, and where does the earlier stage venture capital?
Yeah, so we target 5 to 10% ownership. But by the time a company is ready to exit, whether that's an acquisition or IPO or whatever that may be, I mean, we might own as little as 1% of the company, because we, as seed investors, get diluted very quickly. And we do, you know, try to keep up with our pro rata, but as companies go on to raise bigger rounds, you know, we get pushed out of it, which is something that we are totally okay with. We understand that that's the name of the game. But yeah, we start with between 5 and 10%, and can end up with less than 1%.
Right. So, you know, I hear, you know, when you talk to early stage companies, it really aren't that knowledgeable about the investment process. A lot of entrepreneurs have the idea that venture capital is bad, right? That all they want to do is take over your company, leave you with nothing at the end of the day, right? Which couldn't be anything further from the truth, obviously. But talk about a little bit about what the venture capital firm, any venture capital firm, brings to the table. What can they do for a company that really makes giving, you know, a piece of your company, taking a piece of your company out of your pocket? What else is there? What other advantages does a venture capital
Yeah,
firm bring to the
and
table?
we also have to pitch ourselves to the entrepreneur as much as the entrepreneur has to pitch themselves to us, especially you know, with the market being as hot as it is, and you know, the New York community is pretty small. So you know, I think that the main things that any VC brings is connections, so introductions to either later stage VCs. So for example, we do a lot of introductions for Series A, and then kind of just operational expertise as well. Two things that we really try to sell ourselves on to entrepreneurs is one, everyone on our team has operational experience, especially the partners, so being able to have strategic conversations with them is invaluable. And then two is just the size of our portfolio. So we have over 160 active companies, which is 160 founders and entrepreneurs that the other companies have access to. So every VC kind of has their own, you know, take on what differentiates them, but you know, your VC is there to help you. They want you to succeed as much as you want to. Your, you know, everyone is perfectly aligned if the deal is done correctly, and it's only a mutually beneficial relationship.
Okay, great, thank you, Andrea. Does anybody have questions before we move on? In the back?
Sorry, so what, after we raise money from a VC, what happens next? We just go back to running our business, or create a board, or how does that happen?
Yeah, so, are you talking about at the seed stage?
Yeah,
Okay.
so
Yeah.
closed the deal, you took your money,
Yeah.
now what?
So we don't take board seats, other seed stage VCs will. So normally, you know, a company at that stage will have a small board. A lot of times they come in with advisors already. But really, you know, at that point, it just becomes kind of a relationship. You know, you reach out to your VC when you need help. You know, we ask our entrepreneurs to check in with us every 4 to 6 weeks, and to really try to take advantage with us as much as possible. But you know, we try to stay out of your way as well. We don't want to be, you know, breathing down your neck, hindering you from running your day-to-day operations. So you know, I think it does take a little while to get into a groove with your investor. Every investor is different and is expecting different, you know, different things. But for us in particular, it just automatically turns into kind of a family type relationship. We plug you into all of everything that we have to offer, and then let you kind of go back to running your business.
On average, over 2 or 3 rounds of funding, what percentage of your business can you expect to give away?
I would say probably around 20 to 30%, accounting for the option pool as well. I mean, obviously, you know, as you get up and up there, that kind of gets slivered away. But you know, I think between like a seed and a Series A, you can be expecting to give away 20 to 30%. And especially for us seed investors, it's extremely important that you have a robust option pool, because that's the way that you're going to keep and attract your talent, which is really important at that stage.
You said you do 50 deals a year?
Yes.
Are there certain sectors or subsectors that you're most active in?
So we are generalists, so we look at any seed stage deal in New York City. So we look at probably over 1,000 deals a year. Because we kind of just try to invest where we think we can be helpful, which is where we have kind of background. So commerce, mobile, anything consumer, and SaaS are probably where the most of our investments lie. But we also have outliers as well. So it really is about the connection with the team and the business.
Okay, no more questions. So let's go back to the debt arena. So I'd like to introduce Robin Gill. Robin runs the venture bank at City National Bank. Best kept secret in New York, right, Robin?
Exactly. We spell city correctly.
Right. There you go. Rob, the venture banks in the city, I mean, I don't know if you all are familiar with that community, but most of the time you hear the names Silicon Valley Bank, which Robin is an alum of, and Square One Bank, Comerica, but City National is, I guess you're the new kid on the block, right?
Yeah, we've been in the business for just about 2 years, a little over 2 years nationally.
Okay, and City, just so everybody becomes aware of who you are, City National is a West Coast bank, right? Bank to the stars, right?
Headquartered in LA, been around for over 60 years, working with entrepreneurs from day one. Just happens to be more entrepreneurs in the entertainment space, so celebrities, business managers, talent agencies. That's really where the bank's gotten its name. And then over the years expanded both geographically to New York, Tennessee, Florida, Atlanta, and then expanded verticals into technology and other expertise spaces.
So you're a bank, right? So what's different about a venture banking model versus the traditional banking model?
Yeah, so I think the biggest difference is there are no boxes, as you always hear banks refer to. There's no, you check these 3 different things and we'll be able to give you a loan. It's all very customized debt solutions that are structured in a way that helps the company with what they need. So, the biggest difference is what we talked about earlier, is the profitability. We have here in New York, of our clients, I'd say less than 5% are profitable. So 95% of our companies are losing money. The difference between, maybe where Aaron comes in or where equity comes in is our companies have enterprise value. At least we believe that there is enterprise value well in excess of our debt, so we're a complement to equity. We're not necessarily a replacement of equity.
Right, so usually you like to see, before you'll lend money to a company, you like to see a venture capital firm in there already, right? So why do they need, if we just raised our A round, right? Let's just say we raised $5 million, right? What do we need to borrow? Why do we need to borrow? Why additional costs? What's, how does that work?
Yeah, no, so there's many different reasons why a company at that stage would want to borrow. And it sometimes is driven by what line of business they're in. So here in New York, you have a lot of ad tech companies. Typically, there's a lot of receivables that are slow paying, so maybe you need it for working capital. There might be an e-commerce company, you need to build up inventory. There's different types of situations where debt is much more efficient to be used than equity because it is so much cheaper. There's also the more traditional venture debt, which is term loans that are intended to extend the runway. So that's the hardest thing to explain to an entrepreneur after the Series A round is, okay, you have 12, 18 months of runway, but maybe put on a little bit of debt on the books or the option to use the debt to extend the runway a few extra months on the back end. And the value there is really maybe a milestone is just on the horizon and you want to achieve that in order to get a higher valuation. or a SaaS company that has truly proven the metrics of customer acquisition, revenue coming from it, and every incremental sale you have drives the valuation up, you want to be able to extend the runway as far as possible.
I got that. Okay, so you had mentioned to me that you're a venture bank, right, versus you hear the terminology venture debt firms, right? What's the difference between what you do, right, as a venture bank versus what a venture debt firm would, and how they lend?
Yeah, so I think one of the things that's interesting is, as Aaron alluded to, the stage in which we all play on, I think you're seeing on the equity side, you're also seeing on the debt side, is it's changing a little bit. So, I mentioned that we're not an alternative to equity, but at the end of the day, we do provide runway. So while we consider ourselves debt players and we're a complement to equity, every day of runway that someone's willing to provide you is essentially some form of equity risk. The difference between what we do on the banking side, being a regulated institution, versus a venture debt player, which is more a firm that has raised money from LPs similar to a VC, but they're just doing debt, is the degree to which we complement or replace equity. And a venture debt player, you see, is going to be more willing to replace equity with debt, maybe extend a company 12, 18 months of runway, whereas a bank or a venture lender in our world is more comfortable in that 3 to 6 month runway extension situation. So rates. So right now, the rates vary by product, as you imagine, and it also varies by size of the debt to equity as well as runway. But right now, the nice thing for entrepreneurs is we're banks, we're lending our deposits. So us and a few of the other banks that you mentioned are very deposit heavy, given the nature of, both in City National banks, the entertainment clients, the high net worth individuals, as well as technology companies. We have a lot of deposits, and deposits are effectively free. As you know, you're not getting paid on your money in your DDA today. So we're lending right now, it's all prime based, but you're seeing rates in the 4 to 6% range for both working capital financing as well as true runway extension. And then we do have a small piece of warrants that we do take on. I always describe it to entrepreneurs as we only ask for warrants if we believe that we're adding some equity value. So while it's not a year of runway, but if it's a couple of months, we're going to want a piece of equity for that loan, but it's basis points of the company compared to percentages.
So one last question, Ron. So I'm hearing that the ideal client, the ideal company would be a company that's raised and has an affiliation or an association or a partner with a venture capital firm as an add-on, right? But how about there are a bunch of early stage companies, right? Is if they're just starting up, right? Or they maybe they have friends and family round, or maybe they have a small angel round, right? Is that a good time to approach a bank like yours? Talk to to the appetite of the bank in terms of wanting to develop the relationships with a company. So when it comes time to get that that bigger piece of funding, right? Is that something that the bank likes to entertain, or?
Yeah, I think that's it's interesting. People focus on debt when they think of banks, but at the end of the day, you think about how many times a company will interact with their bank, and wires, ACH, credit cards. There's a lot of different things that an entrepreneur has to think about on the banking side, and the difference between what my group does and what maybe if you walk into a branch at B of A is a level of support that you're going to get from your team. So City National, we're a relatively small team, so we're very selective with the companies that we even bring in on the deposit side. So we're bringing in the companies that we truly believe will go and raise VC money one day. So we're going to dedicate our time. We're going to offer free banking for the first year, and we're going to invest in that company alongside the entrepreneur and the friends and family, with the hope that the company goes and raises VC money down the road, at which point we'll start talking about the debt arrangement. But the main thing is being able to get a senior person that can actually make things happen and give the level of support isn't easy to find at the traditional corner banks, and that's what we try to offer to earlier stage companies as a value add.
Great. Any other questions for Robin? None? Well, in closing, I'd just like to tell everyone here that this presentation was supposed to whet your appetite, right? This is a series, if you don't have it in your head already, right, this is a series of 9 additional events, one each month without July and August for the summer. And just to give you, if you haven't seen it, I don't have it on the screen, but so the next event, which is actually scheduled for March 31st, we're actually going to take a deep dive into angel investing. And then we're going to have the next event, which is scheduled for April 23rd, is on VC funding. All right, and then we're going to talk about the pitch, and then we're going to talk about alternative funding, and then the next topic is got funding, now what? We're going to talk about the timing of the exit. We're going to talk about the IPO. And once you've exited and you got all this money in the bank, we're going to talk about wealth strategies as you look towards your exit. So this is, we urge you to come out to these future events to learn. It's a great way to network, to come in contact with the people who you could be in business with at a future date. And we truly look forward to, we thank you for coming out tonight. The weather's not great. We truly look forward to seeing you over the next year as we play this series out. Thank you all very much, and thank you for your time.